December 26th, 2025. The spot price of silver is trading 60 cents higher than the December futures contract. Doesn't sound like much, right? Just 60 cents? But here's what that number actually means. Each COMEX silver contract represents 5,000 ounces. That 60-cent spread translates to $3,000 per contract in mispricing. And in a functioning market, that shouldn't exist for more than a few hours. Arbitrage traders should close that gap instantly. Buy the cheap futures, sell the expensive spot, pocket the difference, done. Except they're not. The spread has persisted for 2 months. Since October 2nd, silver has been in backwardation. And as we approach delivery deadlines, instead of narrowing, it's getting worse. This isn't a technical glitch. This is the market screaming that physical silver is scarce right now, and paper promises for future delivery aren't trusted the same way. And when you dig into what's actually happening beneath the surface, vault drains, delivery requests spiking to 60% of available inventory in 4 trading days, lease rates hitting 32% when they should be under 1%, the picture becomes clear. The COMEX is under stress. Real stress. The kind that historically precedes either massive price moves or emergency rule changes that rig the game. Let me show you exactly what backwardation means, why 60 cents is actually catastrophic. What happened the last time silver did this in 1980, and why the next few months could determine whether the paper silver market survives or implodes. Because understanding this pattern isn't just interesting, it's the difference between seeing what's coming and getting blindsided when the system breaks. First, let's talk about what backwardation actually is. In normal markets, the futures price sits above the spot price. This is called contango, and it makes perfect sense. If you're selling someone silver for delivery 3 months from now instead of today, you need to cover storage costs, insurance, financing charges. Those costs add up, so futures contracts naturally trade at a small premium. Maybe 20 cents, maybe 50 cents, depending on how far out the delivery date is. This is normal. This is how commodity markets work. Backwardation is the opposite. The spot price, what you pay for immediate physical delivery, is higher than the futures price. The market is paying more for silver today than for silver delivered months from now. And this shouldn't happen, ever, because if it does, arbitrage opportunities appear. Traders buy the cheap futures, take delivery, turn around, and sell the physical at the higher spot price, instant profit. That process should eliminate backwardation within hours, maybe days. But silver has been in backwardation for 2 months, and the spread just hit 60 cents heading into the December delivery period. That's $3,000 per contract. Traders aren't arbitraging it away. Why? Because one of two things is happening. Either they can't get physical delivery when the futures contract matures, meaning the COMEX doesn't have the metal, or they don't trust the exchange to deliver at all. So the futures contract is being priced as a paper promise with counterparty risk. Both explanations are catastrophic. If the COMEX can't deliver physical metal against contracts, the entire pricing system breaks. If traders don't trust the exchange to honor deliveries, the futures contract becomes meaningless as a hedge. Either way, you're watching a system designed to provide price discovery and liquidity start to fail in real time. And this isn't theoretical, it's measurable. Right now, as of December 26th, the silver market is showing stress across every single metric. Start with COMEX registered inventory. Registered silver is metal available for immediate delivery against futures contracts. This is the supply that matters. As of mid-December, registered silver stood at approximately 150 million ounces. Sounds like a lot, it's not. Because in the first 4 trading days of December, 47.6 million ounces were claimed for delivery. That's over 60% of registered inventory in 4 days. Unprecedented. The fastest vault drain in modern COMEX history. On one single day, 7,230 silver contracts representing 36.65 million ounces requested physical settlement. That's roughly 30% of the COMEX free float in one session. And the exchange had to deliver. They met those demands, but only by draining vaults at a rate that cannot be sustained. If delivery requests continue at even half that pace, the registered category runs dry within weeks. Now, the COMEX does have total inventory of about 450 million ounces, but most of that is eligible, not registered. Eligible silver is stored in COMEX warehouses, but it belongs to someone else. Maybe it's ETF holdings. Maybe it's private investors using COMEX vaults for secure storage. That metal isn't available for delivery unless the owner decides to convert it to registered status. And right now, they're not. Why would they? If you own physical silver and you see backwardation, lease rates spiking, vault drains accelerating, you hold tight. You don't lend it out. You definitely don't convert it to registered and risk having it delivered to someone else. This creates a doom loop. Delivery demand increases. Registered inventory falls. Backwardation deepens. Lease rates spike even higher. Owners hoard metal even tighter. The cycle reinforces itself. And the lease rates tell the story. Silver lease rates measure the cost of borrowing physical metal. In normal markets, they sit at 0.5% to 1% annually. Cost of storage, nothing dramatic. In October 2025, they spiked to 32%. In December, they're still elevated at 7.3%, the highest sustained level in over a decade. That means institutions are desperate to borrow silver, probably to meet delivery obligations, and they're willing to pay outrageous interest rates to get it. When lease rates hit 7%, something is breaking. The last time silver lease rates exceeded that level was 1979, and we all know what happened in 1980. Silver hit $50 an ounce. Then the COMEX changed the rules, crashed the market, and blamed the Hunt brothers. Let's talk about that. Because what happened in 1980 is the playbook for what could happen now. And if you don't know the story, you won't recognize the pattern when it repeats. In 1979, Nelson Bunker Hunt and his brother William Herbert Hunt started accumulating silver. Massive quantities. They bought physical metal, flew it to Switzerland in planes guarded by armed ranch hands, and kept buying. They also accumulated silver futures contracts, over 100 million ounces worth. By January 1980, they controlled roughly 1/3 of the world's tradable silver supply. And the price exploded. Silver went from $6 in early 1979 to $50 by January 1980, a 7 and 13% gain in just over a year. The Hunts claimed they were hedging against inflation. The government claimed they were trying to corner the market. Probably both were true. But here's what matters. The silver market entered deep backwardation. Spot prices were higher than futures because physical silver was being hoarded. Industrial users, jewelers, anyone who needed silver for manufacturing was panicking. Tiffany's took out a full-page ad in the New York Times condemning the Hunts for making silver unaffordable. And then, January 21st, 1980, the COMEX changed the rules. They implemented Silver Rule 7. This new rule restricted margin purchases of silver futures and imposed position limits. Traders could no longer go long silver. They could only liquidate existing positions. Liquidation only. Think about what that means. You're telling the market you can sell, but you can't buy. What happens to price? It collapses. Guaranteed by design. The Federal Reserve under Paul Volcker quietly pressured banks to stop lending for precious metals speculation. Credit dried up instantly. The Hunts, who had borrowed billions to leverage their positions, got hit with massive margin calls. They couldn't meet them. And on March 27th, 1980, Silver Thursday, the price crashed from $21 to $10 in a single day. A 50% decline. The Hunts lost over $1 billion. They nearly took down major brokerages and banks. The Fed had to orchestrate a $1.1 billion emergency bailout to prevent systemic collapse. And here's the lesson. The COMEX has the authority to change the rules mid-game when they decide the market is threatening stability. They did it in 1980. They can do it again. Fast forward to today. We're seeing the same setup. Different players, different scale, but the same structural stress. Silver is in deep backwardation. Lease rates are spiking. Vault inventories are draining. Industrial demand is surging from solar panels, electric vehicles, 5G infrastructure, AI data centers. Investment demand is surging as people flee currency risk, and supply is constrained. Mine production hasn't kept pace. Recycling isn't filling the gap. The Silver Institute reports structural deficits, more silver consumed than produced, for 7 consecutive years. On top of that, China is tightening its grip. Reports suggest China may restrict silver exports starting January 2026. China controls roughly 70% of global silver processing capacity, 40% directly and another 30% indirectly. If they cut exports, the West has a problem, a big problem, because Western industrial users depend on Chinese refining. Solar manufacturers, electronics companies, they need that supply. If it gets cut off or restricted, the physical market gets even tighter, and we're already seeing the effects in Shanghai. The Shanghai Gold Exchange spot price hit $78.49 per ounce on December 24th. That's an $8 per ounce premium over COMEX futures. $8. In a normal market, arbitrage would close that gap instantly. Ship metal from New York to Shanghai, pocket the difference. But it's not closing, because shipping takes time, requires financing, and right now anyone holding physical silver in the West isn't selling. They're holding or taking delivery themselves. Shanghai is in backwardation too. The Shanghai Futures Exchange is showing spreads between contracts that signal immediate supply stress. And here's the kicker. China doesn't play by COMEX rules. If the Shanghai Gold Exchange decides to set prices based on physical scarcity, and Western exchanges are stuck trying to defend paper pricing with dwindling inventory, you get a permanent decoupling. 2 prices, a physical price set in Shanghai based on real supply and demand, and a paper price set in New York based on futures contracts that can't be delivered. Andrew Maguire, a precious metals trader with decades of experience, has been sounding the alarm. In a recent interview, he pointed to the 60-cent backwardation heading into December delivery and said, "This is unprecedented. These spreads should be arbitraged away in a functioning market. The fact that they're not means the market isn't functioning. It's broken or breaking. McGuire predicts silver could hit $80 or higher as COMEX's price control mechanisms disintegrate. And if backwardation deepens to $3, $5, $10 permanent spreads, the entire system resets around physical markets like Shanghai. COMEX becomes irrelevant. Now, here's where it gets interesting, because the COMEX has options, and none of them are good for paper silver holders. Option 1, they deliver the metal, but they can't. They don't have enough registered inventory to meet sustained delivery demand at this pace. If institutions, refiners, industrial buyers keep demanding physical settlement, the vault's empty. And once registered inventory hits zero, the exchange has a legal obligation they cannot fulfill. Default. Option 2, they shift to cash settlements. This is what many analysts expect. Instead of delivering physical silver, the COMEX just pays out the cash equivalent at the contract price. Problem solved, right? Wrong. Because once you shift to cash settlement, the futures contract stops representing physical silver. It becomes a derivative, a bet on price movements, but disconnected from actual metal. And if industrial users can't get physical delivery, they stop using COMEX contracts for hedging. They go elsewhere, Shanghai maybe, or private bilateral deals. The COMEX loses its role as the price discovery mechanism. And worse, if cash settlements become the norm, the discount between paper and physical prices becomes permanent. You're holding a contract that says you own silver, but you can't actually get the metal. That contract becomes worth less than physical, maybe a lot less. Option 3, they change the rules. Silver Rule 7, version 2.0. The COMEX, with backing from regulators, could impose emergency measures, position limits, margin increases, liquidation-only orders, anything to force sellers into the market and bring prices down. This is the 1980 playbook. And it worked. Sort of. It crashed the price, wiped out the hunts, and restored control. But it also destroyed trust. Anyone paying attention in 1980 learned that futures contracts aren't safe when the system is under stress. The exchange will change the rules to protect itself, not you. And if that happens again, the exodus from paper silver accelerates. People demand physical only, which makes the supply problem worse, not better. All 3 options are bad. Deliver the metal, they run out. Cash settlements, the contract loses legitimacy. Change the rules, trust evaporates. The COMEX is trapped. And the market knows it. That's why backwardation persists. That's why lease rates are spiking. That's why vault drains are accelerating. The market is pricing in the risk that the COMEX system fails, or at minimum, that the gap between paper promises and physical reality becomes permanent. And here's the part that should terrify anyone holding silver ETFs or futures contracts without understanding what they actually own. Because not all silver exposure is created equal. If you own physical silver, coins, bars, stored in your possession, or in allocated storage where the specific serial numbers are registered to you, you're fine. You own metal. No counterparty risk. When the system breaks, you're holding value. If you own unallocated silver, pooled storage where you're owed X ounces but not specific bars, you have counterparty risk. If the storage facility doesn't have the metal or goes bankrupt, you're in line with other creditors. You might get paid, you might not. If you own silver futures contracts, you're holding a paper promise that the COMEX will deliver metal or cash settle at contract expiration. If they change the rules, cash settle or default, your contract's value could evaporate. Yes, you can take delivery. If they have metal available, if you meet all the requirements, if the exchange doesn't declare force majeure and suspend deliveries, big ifs, if you own silver ETFs like SLV, you're owning shares of a fund that supposedly holds physical metal. But read the fine print. The fund can cash settle under certain circumstances, and the metal is unallocated. You don't have claim to specific bars. You have a claim on the fund's performance, which is tied to the spot price, which the fund's custodian helps set. Circular. And if physical scarcity causes premiums on coins and bars to spike 30, 40, 50% above spot, your ETF doesn't capture that. You get spot performance. Physical holders get the premium. This is why understanding the structure matters. Because when backwardation persists, when vault drains accelerate, and when exchange default risk becomes real, the different forms of silver exposure diverge in value. Physical outperforms, paper underperforms, and the spread can be enormous. We saw this in 2020 during COVID. Silver spot price was around $25 to $28. But physical coins were selling for $40 to $45 at dealers, a 60% premium. Why? Because mints couldn't produce fast enough. Shipping was delayed. Vaults were restricting withdrawals. People wanted metal, not paper, and dealers charged whatever the market would bear. If you owned SLV, you got $28 performance. If you owned physical, you could sell for $45. Same metal, vastly different outcomes based on form of ownership. Now imagine that scenario, but permanent. Imagine backwardation doesn't resolve. Imagine physical premiums stay elevated because the paper market can't deliver. That's the scenario we're potentially entering. And it's why the 60-cent spread, the $3,000 per contract mispricing, is such a critical signal. So what's the timeline? When does this break? Nobody knows for sure. But history gives us clues. The Hunt brothers' squeeze took about 18 months from accumulation to collapse, 1979 to 1980. The current backwardation started in October 2025. If it follows a similar pattern, we're talking spring or summer 2026 for some kind of resolution. Either the COMEX delivers and survives, or they run out of metal and the system resets. But there are also shorter-term catalysts. The January 2026 contract is already showing record open interest for a minor delivery month. That means more people are demanding physical delivery in January than any previous off month. If that demand materializes, as if tens of millions of ounces get claimed in January, the drain continues. And registered inventory, which stood at 150 million ounces mid-December, could drop below 100 million by February. At that point, one large institution demanding delivery could empty the vaults. China's export restrictions, rumored to start January 2026, add another variable. If Chinese refined silver stops flowing west, where does the COMEX get metal for delivery? Mexican mines? Canadian refiners? Possible, but not fast enough to replace Chinese capacity. The supply chain fragments. And fragmented supply chains mean regional price dislocations. Shanghai trades at a premium because metal is trapped there. New York trades at a discount because it's short metal but long contracts. Then there's the Fed. The Federal Reserve meets December 9th and 10th, just days ago. If they cut rates, the dollar typically weakens. Weaker dollar, higher gold and silver prices. Higher prices, more speculative interest. More speculative interest, more delivery demands. The cycle accelerates. This demand doesn't stop. It's structural, and it's growing. The Silver Institute projects industrial demand at 750 million ounces in 2025, up from 680 million in 2024. That's 70 million ounces of additional consumption. Where does it come from? Not from new mines. Those take years to develop, from existing stockpiles, from COMEX vaults, from Shanghai inventories, and those stockpiles are draining. Put it all together. Backwardation persisting, lease rates elevated, vault drains accelerating, Chinese export restrictions looming, industrial demand surging, and a Fed that might ease, creating weaker dollar conditions. The 60-cent backwardation isn't just a number, it's a signal, a warning, a countdown maybe. The COMEX has been the center of silver price discovery for decades. It's provided liquidity, hedging, and a mechanism for industrial users to manage risk. But that system was built on an assumption that only a small percentage of contracts would ever demand physical delivery, that most traders would roll contracts forward or cash settle. That assumption is being tested right now. And if it fails, if delivery demands overwhelm available inventory, if the exchange is forced to default or suspend deliveries or shift entirely to cash settlements, the silver market doesn't end. It just moves to Shanghai, to private bilateral deals, to physical-only markets where paper promises don't matter. And when that happens, the people holding physical metal will dictate price. Not the COMEX, not the futures traders, the people with the actual metal. History doesn't repeat, but it rhymes. In 1980, silver hit $50, then crashed when the rules changed. But the fundamental scarcity was real. The hunts were just the visible players. The real demand came from inflation fears, currency instability, and supply constraints. Same drivers we have today. And after the crash, after the Hunt brothers were wiped out and silver fell to $10, what happened? Over the next decade, silver slowly climbed back. It hit $50 again in 2011. Different players, same pattern. Scarcity drives price. Authorities intervene when it threatens control. Price gets suppressed. But the underlying dynamics remain. And eventually, scarcity wins. We might be watching that pattern set up again. The 60-cent backwardation is your early warning. The $3,000 per contract mispricing is your evidence. And the fact that this has persisted for 2 months, the longest sustained backwardation since 1980, is your confirmation that something fundamental is shifting. Not tomorrow, but soon. And understanding that shift, that pattern, is the difference between seeing what's coming and getting blindsided when the countdown reaches 0,